What if I told you that there is a company making hundreds of millions in profit, donating almost all of it to fight climate change and still staying tax efficient? Meet Patagonia. The founder literally said, "Earth is now our only shareholder." Since 1985, they've donated over $100 million to environmental causes, and when US tax cuts saved them $10 million in 2018, they gave it all away. But here's the twist. They are obviously not stupid, they're not reckless, or at least their accountants aren't. They still use a global structure, they still make money, and yes, they still deal with transfer pricing. So the real question is, can transfer pricing be ethical and somehow still efficient? And if so, how the heck Patagonia pull it off? So let's break it down. Let's be honest. When you hear transfer pricing, you probably don't think of environmental activism or ethical business models. You think tax tricks, legal gray zones, and companies shifting profits to Bermuda. And to be frank, to be fair, you are not entirely wrong. For example, lately, for decades, the transfer pricing game has been about how far you can push the rules before a tax auditor rings your doorbell and even asks to see your homework for the last 5, 6, sometimes 7 years before. But what if I told you that transfer pricing doesn't have to be shady? What if it actually could reflect where the value is created, who does the hard work, and what kind of impact a company wants to make? Because that's exactly where Patagonia comes in. They are global. They source from Vietnam, Sri Lanka. They sell in Europe, US, and Japan. They own intellectual property. They manage R&D, branding, retail, etc. So yes, they face the same challenges as every multinational. Where should be profit taxed? How should the value be allocated? But here's the difference. Their goal isn't just to maximize shareholder value, because their only shareholder now is the Earth. So this changes everything. Their decisions are no longer just about tax efficiency. They are about long-term impact, credibility, and alignment. So when it comes to transfer pricing, to pricing the goods between their own entities across borders, they are not playing the race to the bottom in this case. They are asking, what would fair, arm's length pricing look like if we actually cared about the planet? So they focus on their purpose, profit, and transfer pricing. So let's dive in. All right, let's look under the hood. Patagonia isn't just a nice brand with a heartwarming mission. It's a global business, and like any multinational, it has to deal with cross-border transactions, supply chains, and obviously tax rules. And so here's the simplified version of how it works. They design in the United States. They manufacture in countries like Vietnam, Sri Lanka, or Mexico. They sell in the US, Europe, Japan, and beyond. Their headquarters and R&D are based in California. And the Patagonia brand, they're like intellectual property. That's a huge piece of value. Patagonia works with 45 suppliers and factories in 14 countries, including Vietnam, Thailand, China, Sri Lanka, India, and even Bangladesh. So when one entity sells to another, they need to set an internal price. That's where transfer pricing comes in. Let's take a real-world example. Say their Vietnamese factory subsidiary produces a $40 fleece. They ship it to the US marketing entity, which sells it online for $150. Now the question is, how do you divide that $110 of margin? How much profit stays in Vietnam? How much goes to the US? And how much is attributed to the IP? This is where multinationals use transfer pricing methods like cost plus for manufacturing, TNMM, this is the transactional net margin method for services, for example, and licensing for brands and IP. If Patagonia were profit maximizing like some fashion giants, they might push most profits to a tax haven that is holding the IP, like Luxembourg or Cayman Islands, or perhaps a lovely little island made entirely of untaxed profits with its own umbrella. But that's not how Patagonia plays. Their mission isn't to maximize, to minimize the tax. It's to be transparent, compliant, and fair. Instead of using the savings to enrich ourselves, we are donating it to the planet, our only shareholder. That was said by Rose Marciano, former CEO of Patagonia. And they don't stop there. They publish impact reports, like to trace their supply chains via the Footprint Chronicles. And they are a certified B corporation, scoring 151 points in their latest audit, one of the highest scores in any global brand. For reference, the minimum B Corp pass score is just 80. So like to recap, they build substance where work is actually done. They allocate profit in line with the value creation, and they are not hiding behind mailbox companies or shell entities. So does it sound realistic? Maybe. But as well, we will see in the next section, this kind of structure can still be tax efficient without cheating the system in any way. Okay, so let's define the core idea. What do we actually mean when we say ethical transfer pricing? Because here's the truth. Transfer pricing is not illegal, right? In fact, every multinational has to do it. The question is how they manage it. The gold standard here is the OECD transfer pricing guidelines. They're built around one key idea, which is mentioned many times in my previous videos, the arm's length principle. That means if two independent companies were doing the same transaction, like same product, same risk, same functions, what price would they agree on? That's your benchmark, right? So far, so good. But in practice, multinationals have tons of flexibility in how they interpret this. That's where actually the games begin. Let me try to compare it for you. Like, for example, aggressive TP might look like this. Shifting profits to a zero tax jurisdiction, using shell companies with no substance, charging inflated royalties to drain cash from high tax countries. On the other side, ethical TP could look like allocates the profits where value is actually created, uses real economic substance, follows the OECD methods, and doesn't push the limits. So ethical transfer pricing means complying with international rules, documenting functions, assets, and risks honestly, avoiding artificial arrangements that distort economic reality, accepting that sometimes you will pay more tax in high tax countries, and that's okay. Let's take intellectual property. Where does the value come from? It's not just the legal owner on paper, it's the people who develop the IP, enhance it, maintain it, then later protect it and exploit it. That's DEMPE framework, and it's at the heart of ethical pricing. If Patagonia's IP is developed and protected in the US, then ethically, that's where part of the profit should stay. Profits should be taxed where economic activities generating the profits are performed. You can read it in OECD guidelines from 2022. But here's the mindset shift. Transfer pricing isn't about how little tax you can pay. It's about how fairly you can reflect your business reality. And ethical doesn't mean inefficient. In fact, as well as we will see in the next, it can be both smart and sustainable. So how do you structure a global company to be ethical and efficient? Let's build a blueprint in the next chapter. So So let's say we were in Patagonia's tax department, not to minimize tax at all costs, but to build a fair, compliant, and efficient structure. How would we do it? Here's the typical setup. Okay, so the manufacturing entity is in Vietnam. Intellectual property owner is in the US. Sales entity, let's say in France. Now imagine the Vietnam company produces a jacket for $40, all in manufacturing costs. It sells the jacket to the French distributor for $90. France then sells it to the customer for $1,800. So where does the profit go? Vietnam makes a cost plus 15% margin, fair compensation for low risk production. France keeps a routine distribution margin, let's say 10%. The rest, around $60 in profit, goes to the US entity that is holding the brand and design the IP. This is how ethical TP would work, based on real functions, market-based margins, and transparent documentation. Why does most of the profit go to the US? Because that's where the real DEMPE functions happen. So Patagonia Design Studio in Ventura, California, global brand strategy, R&D, product innovation, environmental materials research, legal protection of IP, trademarks, logos. In short, that's where the value is created. Now let's contrast that with how some aggressive players do it. Take a well-known sportswear brand, let's call them Schmeiki. Any resemblance to actual brands living or untaxed is purely coincidental. They shift their IP to a Dutch entity that licenses it to low-tax entity that are shifting the profits to Bermuda. And the results? All profits end up in a black hole with zero substance and zero tax. Patagonia, they don't play that game. We believe paying our fair share of taxes is part of being a responsible business, said Rosa Marcario, former CEO. And it's not just words. Patagonia published detailed environmental and social impact reports. They disclose their global operations pretty transparently. No shell companies, no mailbox headquarters, and no Bermuda tricks. So could they push more profit offshore? Yeah, sure. Would it save tax? Yes, probably. But they don't do it because ethics isn't something they put on a banner. It's a build into how they price internally. That we've seen how ethical transfer pricing works, you might be wondering, okay, cool. But does this mean paying more tax? Not necessarily. In fact, doing it right can actually save you money. Let me explain. Here's the trade-off that can save you money. Aggressive structures, you might save on a tax short term, but you increase your risk of penalties, audits, litigation, reputational damage, lost sleep. Ethical structures, you pay what's fair, but you gain predictability, trust with authorities, long-term savings, and mainly also sustainability. So let's look at Patagonia again. They could have chased every loophole. Instead, they stayed in high-tax jurisdiction, they built real substance, and they focused on long-term credibility. Their estimated annual revenue is around $1.5 billion. Profit margins are roughly 10%, and they still donated over $100 million to environmental causes. They are not losing money, they are winning loyalty. Think of it like this. If you are transparent with your tax model, you build a reputation, premium. Customers trust you, investors respect you, governments stop harassing you. Try putting that on a balance sheet. The more aggressive you get, the more likely you are to end up on someone's radar. Now imagine you're a tax authority. You open a file and see transfer pricing documentation based on OECD methods, benchmarking reports, real people, real offices, real invoices. You close that file faster than you can say viral dance like challenge that explains tax loopholes. Because there are no loopholes here, because there is nothing to audit. Now compare that to what happened with like Starbucks in the UK. No corporate tax for years. Amazon in Europe, royalties to Luxembourg entity, end result, audits, protests, headlines, forced back payments. Somehow ethical TP avoids all of that. I've seen clients sleep better when they know their structure is fair, defensible, and real. No fear of those knock who's there, oh, just your friendly neighborhood tax auditor with a few hundred questions. No midnight calls from your CFO who suddenly realizes your entire profit structure looks like a badly drawn treasure map. Just clean margins and clean, like, conscience. So yes, ethical transfer pricing can be tax efficient, but here's the kicker. It's not just about saving money. It's about building something sustainable. So, what can your company learn from this? That's what we will explore next. Alright, so you might be thinking, like this Patagonia story is inspiring, but I'm running a tech startup. What does ethical transfer pricing have to do with me? And that's a fair question. You might not have a billion-dollar brand or global manufacturing chains, but the core principles behind how Patagonia approaches its finances and its ethics, those are somehow universal. It's not just about complex tax codes. It's about building a business that you, your customers, and your community can be proud of. It's about how your choices, big or small, contribute to like fair system and build trust. You don't have to be Patagonia to make a positive impact and crucially to benefit from doing things the right way. Think about it from your customer's perspective. We're in an age where ethical consumerism is actually booming. People increasingly want to know where their products come from, how workers are treated, and whether the businesses they support are like good global citizens. They are tired of headlines about corporate giants dodging taxes while communities actually struggle. So even if you are not dealing with cross-border transactions in the same way as Patagonia, the spirit of what they do matters. Being transparent and fair in your financial dealings, even at a local level, builds immense brand reputation. It tells your customers that you value integrity over squeezing every last penny through loopholes. This isn't just nice to have, it's becoming a competitive advantage. Because your reputation for fairness can be a more powerful marketing tool than any flashy campaign. Like, here's what any company, big or small, can actually take from this. First of all, build substance. Make sure you have real people doing real work where you report your profits. When we talk about building substance, having real people doing real work, this isn't just a tax compliance tip. For a small business, this somehow translates into investing in your local community, providing stable jobs and creating real tangible value. This is the bedrock of long-term sustainability. Businesses that are deeply rooted and genuinely contribute to the places they operate are more resilient, more trusted, and ultimately more likely to thrive through economic ups and downs. Chasing short-term gains by cutting ethical corners often leads to a house of cards. Building ethically is building to last longer. Use benchmarking. Don't invent margin. Use market data to support your pricing. And align with value creation. If your development team is in Poland and your sales team is in Germany, make sure your profit is allocated correctly. Keep documentation tight. Transfer pricing reports, local files, CBCR, get them done. And be transparent with the intent. Even a basic rules showed in a transparent way are useful. Being organized, honest, and transparent about your finances always pays off. For a small business, this could mean clear invoicing, fair employee contracts, transparent pricing for your customers, and paying your local taxes correctly and on time. It means that if anyone does ask questions, whether it's a customer, a potential partner, or yes, even the local tax office, you have clear, honest answers. This isn't about fair, it's about professionalism and peace of mind. Say you are a software company. Your developers are in, let's say, Krakow, your clients are in Berlin, and you sell via Dutch holding. It's instead of shifting all of the profits to the Netherlands, allocated based on who actually creates the value. That's ethical, that's defensible, that's smart. I once worked with a client who said, we just want to do the right thing, but we also don't want to be punished for being honest. That client who said we just want to do the right thing, that resonates deeply, because many small business owners actually feel the same. The good news is building a reputation for ethical practices isn't a punishment, it's an investment. Imagine two local coffee shops. One is known for cutting corners, underpaying staff, and being opaque about its sourcing. The other is celebrated for its fair wages, transparent sourcing, and community involvement. Which one are you more likely to support? Which one is building a more loyal customer base and a stronger, more sustainable future? So here's the good news. You won't be, because transparency backed by proper documentation is your best defense. So the bottom line, you don't need to give away your company to the planet like Patagonia to make a difference. But the lessons from their journey are incredibly relevant. Being clear, fair, and prepared in how your business operates financially isn't just about avoiding trouble. It's about building a brand people can trust, fostering sustainable growth, and aligning your business with the values your customers increasingly care about. It's about proving that good ethics is good business, and no matter your size. And yes, that can be incredibly efficient in the long run. So, what did we learn today? Transfer pricing doesn't need to be shady. Ethical doesn't mean inefficient. Patagonia proves it's possible to be values-driven and financially successful. Earth is now our only shareholder. That's bold, that's radical, and it's a challenge to all of us. Whether you run a startup, a consulting firm, or a multinational, you have a choice. Cut corners or build something that lasts. And transfer pricing, that's not just a tax tool. It's a reflection of how your business sees the world. So if you're ready to explore this deeper, subscribe to the channel, drop a comment about should more companies follow Patagonia's lead, or tell us how your company thinks about tax and ethics. This is Michael from Prezzo. If you're ready to structure smarter and want expert help, check out Prezzo, link in the description below. Thanks for watching, and remember, great strategy isn't just about margins, it's about meaning.